My view generally is that you want to be at the barbells and not in the messy middle. That's been the history of crypto from the beginning is hardware wallet, real self-custody, true institutional custody, regulated with protections in place. Those have been great. It's everything else that has been a mess. And as soon as you get away from those two extremes, and I think most people are best served by doing both. There's strong arguments for both. It's everything in the middle that I wouldn't touch. I think we need to go to the edges.
The crypto market has spent months absorbing relentless bad news. Political uncertainty in Washington, institutional selling, ETF, outflows, concerns over artificial intelligence sucking liquidity away from digital assets, and now one of the biggest hardware wallet security incidents in Bitcoin's history have all tested investor conviction. A software flaw affecting certain Coldcard hardware wallets may have enabled attackers to drain nearly $90 million worth of Bitcoin across several waves of coordinated theft. The incident has reignited one of crypto's oldest debates: what's actually the safest way to protect your Bitcoin when even products designed for maximum security can contain unexpected vulnerabilities? In today's interview, Matt Hougan explains why he believes Bitcoin is already in the process of forming a major bottom and getting ready for the next big run. He also shares the macro risks that could derail the rally, gives his latest outlook on the Digital Asset Market Clarity Act, and finishes with how he thinks investors can best protect their cryptocurrencies in 2026 and beyond. There's plenty to unpack, so as you watch, let me know whether you agree with Matt's outlook for the rest of the year. And if you enjoy in-depth crypto analysis that cuts through the noise, consider subscribing and turning on notifications so you don't miss our future market breakdowns. Now, let's get into it.
I think we're in the process of bottoming right now. And I think the bull market that comes out of this bottom is different than the bull markets that we've had in the past. So I do think crypto is resetting into a much more real world oriented vision, a much more revenue driven vision, a much more tangible vision. So I think there is a big reset or a big change coming, and we're just going to start to feel that at the second half of the year.
And when you say Bitcoin is in the process of bottoming, what are the signals you're looking at that tell you that?
Yeah, so there are two things that really always happen in a bottom. The first is that you see signs of leverage being squeezed out of the system. You see signs of apathy emerging. And we saw that at the end of Q2, right? Q2, you had massive outflows out of the ETF complex, you had massive selling. But at the end of Q2, you started to see the leverage really get squeezed out. You saw MicroStrategy trade below its MNAV. You saw Stretch trade down to 75. You saw open interest collapse. You saw funding rates trend towards zero. All the signs that speculative excess in the system were hitting the bottom. And then the big tell to me is always when markets stop reacting to bad news. So, as an example, so far this half, we've had the odds of the Clarity Act take a one-way path downward based on Polymarket, and crypto has been flat to up. We saw MicroStrategy sell Bitcoin and crypto rallied. Even at that moment when Stretch broke, crypto traded flat. When markets stop reacting to bad news, that's usually a sign that the bottom is in. And those are the indicators. There are other things I'm looking at, the 200-week moving average, looking at long-term holders in the Bitcoin community, looking at ETF flows normalizing out. There are 1,000 different signals, but those are the two that really matter to me. And the most important, the most telling signal is when markets stop reacting to bad news. And we have seen that in the crypto industry. Even recently, AI blows up. Crypto's like, whatever. That's a really good sign when you get that kind of apathy. That means there's no more excess excitement and you're ready to move to the next level.
What do you think is the most important macro factor?
Any extreme. So crypto is going to do fine if all of that maintains on a normalized pace. If the Fed raises rates a little or drops rates a little, 25 basis points either side, I don't think it matters, right? It's not percentage point moves. It doesn't reset risk expectations in a massive way. I think that's fine. If oil stays between 50 and $100 a barrel, I don't think it matters. It's not big enough to change the crypto specific factors that are shaping this bull market. If AI does pretty well, but neither goes back to where it's sucking all the oxygen out of the room, nor does the bubble collapse and Frontier Labs go bankrupt and there's chaos. If it's just normal, crypto does great. So if I had to pick one of those, the one I'm most concerned about is the AI one on either side of that binary outcome, either a true bubble bursting, which I don't anticipate, or a rebirth of excitement, which seems more likely to me. Those would take a little bit of the steam out of what I expect to be a good second half of the year in Bitcoin and in crypto. But broadly speaking, we just want everything to be sort of okay. Because the crypto specific trends, I think, are very positive. And as long as macro doesn't get out of the way, I think we're going to do great.
That brings us to the issue dominating conversations across the crypto industry this week, the Digital Asset Market Clarity Act. Time is becoming the market's biggest enemy. The Senate now has only a handful of legislative days remaining before lawmakers leave Washington for the August recess, yet the bill was notably absent from this week's Senate calendar. That omission doesn't mean the legislation is dead, but it significantly complicates the timeline and raises fresh questions about whether leadership can begin formal consideration before senators return to their home states. Under normal Senate procedure, supporters must first file a cloture petition signed by at least 16 senators before debate on the motion to proceed can even be limited. Assuming that hurdle is cleared, 60 votes would still be required to invoke cloture, meaning Republicans would need meaningful Democratic support before the bill could advance. Even then, Senate rules allow for additional debate before lawmakers move toward amendments and eventual passage. In other words, the path forward remains narrow, making the next several days potentially some of the most consequential for U.S. crypto regulation in years. Against that backdrop, here's Matt Hougan's latest assessment of the bill's chances and why he believes its short-term impact could be enormous for the market.
What's your gut tell you about will clarity pass?
Oh, it's really tough. It's really tough. I don't want to answer. You're trying to pin me down. It's so
It
great.
changes every day, so I get that it's like a coin flip.
It changes every day. Look, Polymarket has the odds at something like 30%. I haven't looked today, but that's where it was a couple days ago. I think the probability is higher than that, but probably still less than 50. So I think it's in the high 40s. I really think it's like a coin flip. The pro case is it won't die. And things that don't die, even though they have a million excuses to die, often tend to make it through. So it's shown remarkable resilience. But man, is there Democrat on Trump hatred. And it just feels like ethics is this explosive thing that is going to be hard to shepherd across the line. So I'd take the other side of the poly market trade, but I'm not sure I would take a 50-50 trade on clarity.
What changes in your outlook, at least in the next 2 years, if it passes or if it fails? I would assume if it passes, you're more just pro Bitcoin and the large caps. I mean, if it fails, you're pro the stability, the large caps.
I actually think the impact is much shorter term. If it fails, I think crypto in general struggles for a month or two as it digests that news. And I think smaller cap assets probably struggle more. If it passes, I think it's a shotgun start to a new bull market. That's my broad thesis. I don't know how much it matters over the next 2 years because I think crypto is going to get enough escape velocity over the next 2 years that even a dramatic change in administration won't be able to put it back inside. You just have too many people building in this ecosystem. I think it will be an Uber versus taxis sorts of situation within 2 years. So I think the impact is more shorter lived. But for sure, if it fails, I think there's a reasonable probability that crypto goes through a period of volatility and that hits particularly non-Bitcoin assets. But as you go smaller, the impact is larger. I think that's a logical analysis of what will happen.
Where is the safest place to store your crypto?
Oh man, it's a question everyone is asking right now. It's hard for me to not talk my book. ETFs do a phenomenal job of working with qualified custodians, which have some level of insurance in place and a strong track record over a decade plus of successfully custodying their Bitcoin. So I think that is a good solution. On the self-custody side, there are good solutions out there, but I don't want to recommend one. Feels like a Twitter accident waiting to happen. I think that's it. My view generally is that you want to be at the barbells and not in the messy middle. That's been the history of crypto from the beginning is hardware wallet, real self-custody, true institutional custody, regulated with protections in place. Those have been great. It's everything else that has been a mess. And as soon as you get away from those two extremes, and I think most people are best served by doing both. There's strong arguments for both. It's everything in the middle that I wouldn't touch. I think we need to go to the edges.
The Coldcard hack, one of the largest hardware wallet security failures the industry has seen in years. Security researchers from Galaxy Research estimate that attackers exploited a flaw affecting certain Coldcard wallets, initially draining more than 1,000 Bitcoin from over 1,100 wallets in less than an hour. As additional suspicious transactions were identified, estimated losses climbed to roughly 1,367 Bitcoin valued at around $86 to $89 million, depending on market prices. Rather than breaking the cryptography behind Bitcoin itself, researchers concluded the vulnerability originated from the wallet's seed phrase generation process. A flaw in the firmware's implementation of random number generation made some recovery phrases mathematically predictable, allowing attackers to systematically recreate private keys and empty affected wallets. The lesson extends far beyond a single manufacturer. Hardware wallets remain among the safest methods of storing Bitcoin because private keys stay offline, but no security model is stronger than its implementation. According to engineering analysis released after the incident, the issue stemmed from how randomness was generated during wallet initialization. A fallback mechanism relied on deterministic values under certain conditions, making some seeds vulnerable to reconstruction. Reports also suggest engineering changes made during firmware development unintentionally weakened the original design. Coldcard has since released patched firmware for affected devices and urged users whose wallets may have been generated using vulnerable firmware to migrate their Bitcoin immediately to newly created wallets using updated software. Importantly, this incident should not be interpreted as evidence that self-custody has failed. Instead, it reinforces one of crypto's oldest principles: verify, don't blindly trust. Whether investors choose self-custody or institutional custody, security requires diligence. Firmware should always be kept up to date. Wallet generation procedures should be verified. Recovery phrases must remain completely offline, and significant holdings should never depend on a single point of failure. As institutional adoption accelerates and Bitcoin continues maturing as a global financial asset, operational security is becoming just as important as investment strategy itself. If you enjoyed this breakdown, don't forget to subscribe for more in-depth crypto analysis, and share this video with anyone trying to make sense of where Bitcoin and the broader digital asset market are headed next. Your support helps the channel reach more investors looking for thoughtful, data-driven analysis. Thanks for watching, and I'll see you in the next one.